Greetings, everybody. Welcome to Liberty Call. Today is Thursday, November 2nd, 2023. Hope everybody's having a fantastical day out there. Another happy day in the markets. It seems like everyone is in a better mood today. Let's scroll down through. Chinese markets, not so much. They were red, but and Russia. But the rest of the world seems to be, in a better mood today. So again, I don't know why. I mean, looking out into the future, you can look at the data, the inverted yield curve, and all the financial problems that not just the U.S. central bank has, but all the central banks around the world. So it is a little weird. Anyways, well, if it is your first time watching Liberty Call, I'm glad you're here. Thank you very much. If you could do me a favor, hit the subscribe button, the like button, the thumbs up buttons, all the buttons that are there. Hit the notification bell because you want to know when I go live. Because again, I say this on a regular basis. I occasionally say something intelligent. Not every day, but occasionally. So you don't want to miss out on that. So, all right, let's go ahead and get to the numbers for today. Dow Jones was up 1.7%, 564 points. Woo! Closed at 33,839. The S&P 500 was up 1.89%, closed at 4317. NASDAQ up 1.78, closed at 13,294. The VIX fell another 7.29% today. It's down to 1564. Canada up 2.87. Brazil up 1. Looks like those were closed. Yeah, Brazil and Mexico were closed for some reason today. Moving over to Western Europe, Germany was up 1.48, the UK up 1.42, France up 1.85, the Netherlands up 1.91, Spain up 2.04%, Italy up 1.77, Switzerland up 0.84, and Portugal up 1.16. Russian exchanges both in the red, MOEX down 0.29, the RTSI down 0.79. And the Asian markets, the Nikkei Japan was up 1.2%, Australia up 0.9%, New Zealand up 2.24%. In China, the Shanghai was down 0.45%, the Shenzhen Component down 0.94%, China A50 down 0.2%, DJ Shanghai down 0.58%, and the Hang Seng was up 0.91%. Taiwan weighted was closed. All right. So, like I said, I'm really not sure why everyone's market-wise is in such a giddy mood. I mean, the articles are all like, hey, everything's good, woo! But it's like, seriously, folks? All right, let's go ahead and get to the market recap for today. U.S. stocks in rally mode as Treasury yields in post-Fed slump. All right, U.S. stocks surged on Thursday, driven by a significant decline in Treasury yields as the Federal Reserve opted to keep its benchmark interest rate unchanged for the second consecutive meeting. The positive sentiment extended from the prior day, with the Dow gaining 220 points and the SP rising 1.1 and the Nasdaq climbing 1.6%. Following the Federal Reserve's policy-setting meeting, where it maintained its current interest rate, Wall Street reacted with optimism. Fed Chair Powell hinted at the possibility of a rate hike in December and beyond, but also highlighted that the central bank was not confident that it had reached a, quote, sufficiently restrictive stance. While the economy has shown recent strength, the market interpreted this stance as a sign that the Fed might not be eager to raise rates further. This interpretation pushed Treasury yields even lower, with the 10-year yield dropping by 12.3 basis points to 4.666%. Starbucks Corporation made waves with a more than 10% rally after reporting impressive fiscal third quarter results that exceeded Wall Street expectations. The company's performance was bolstered by growth in its key Chinese market. In contrast, Moderna Inc. reported a wider than expected loss for the third quarter due to a reduced demand for its COVID-19 vaccine. Really shocking. Which led to a $3.1 billion hit from unused vaccines, causing its shares to decline by about 8%. Planeteer Technologies exceeded expectations in its Q3 results, reporting strong demand for its artificial intelligence products. The company provided better than expected full year guidance, projecting higher revenue for Q4 compared to Wall Street estimates. Roku Inc. and PayPal Holdings both experienced significant stock price increases of more than 30% and 6% respectively. After delivering better than expected quarterly results, Roku's resilience was attributed to expanding its platform subsegments, diversifying its advertising product offerings, and launching new advertising products. Oil prices rebounded on the back of the Fed's decision to keep interest rates unchanged. The resulting impact on the U.S. dollar and improved risk appetite in financial markets contributed to the price recovery, despite U.S. inventory data showing a slightly smaller than expected build in oil inventories over the week to October 27th. The focus shifted to the broader macroeconomic context, where the Fed's dovish stance influenced market dynamics. So everyone's in a good mood today. Just wait till things go bad and everyone will be screaming, "Oh my God, the sky is falling." All right, let's get to some jobs data. U.S. weekly jobless claims rise marginally. Productivity accelerates in Q3. Let's see what that is all about. All right, the number of new jobless claims in the United States saw a moderate increase last week as the labor market continued to display resilience. However, the report also indicated an increase in unemployment rolls to a 6-month high, leading to differing opinions among economists about whether this points to a significant shift in the labor market. Continuing claims have been rising since mid-September. Some economists downplayed the increase, attributing it to difficulties in seasonal data adjustment, as a similar pattern occurred last year during the same period without causing an uptick in the unemployment rate. Others viewed it as a sign that laid-off workers are facing longer unemployment spells. The report revealed that initial claims for state unemployment benefits rose by 5,000 to a seasonally adjusted 217,000 for the week ending October 28th, surpassing economists' expectations of 210,000. The labor market, although gradually cooling, remains tight, emphasizing the economy's ongoing strength with 1.5 job openings for every unemployed person in September. While seasonal adjustment issues may have influenced the rising continuing claims, the labor market continues to display resilience. Meanwhile, a separate report from Challenger Gray and Christmas indicated, and that's a company that keeps track of all the layoffs around the country, indicated a decrease in job cuts in October, down 22% from September, but up 9% compared to the previous year. The encouraging news was reflected in worker productivity, which increased at the fastest pace in 3 years during the third quarter, subsequently dampening labor costs. This productivity surge will assist the Federal Reserve in its efforts to bring inflation back to its 2% target. Kind of curious how that would happen. Non-farm productivity, measuring hourly output per worker, grew at 4.7% annualized rate in the last quarter, the quickest since Q3 of 2020. The jump in productivity was in line with the robust economic growth seen in the third quarter, indicating increased investment in technology, including generative AI. Unit labor costs fell in the third quarter, providing a favorable indicator for core inflation and contributing to the Fed's decision to remain on the sidelines regarding rate adjustments. So, jobless claims are slightly going up, but, nothing terrible. I mean, certainly not like the madness of 3 summers ago. So. All right, next up, an article from Zero Hedge titled "Bank of Japan is Brewing a Storm in Global Markets." And for anyone who's been paying attention to Japan knows that they have inflation out the wazoo, so it's not good. All right, the Bank of Japan continues to maintain an ultra-loose monetary policy, and this stance is contributing to underlying imbalances in global markets, potentially leading to a sudden and significant increase in asset volatility. The Bank of Japan's decision not to exit its ultra-loose policy stance and its adjustments to yield curve control without increasing the negative policy rate are having a profound impact on global markets. These are some of the anticipated consequences of the Bank of Japan's persistently loose monetary policy. 1, a yen rally. The yen is likely to experience a substantial and rapid rally. FX hedging ratios, which have lapsed, are expected to reestablish, and some foreign capital may be repatriated. Rise in global bond yields. Longer-term yields in the U.S. and other developed markets are expected to increase. Short-term rate increases. Short-term rate expectations in Japan versus the U.S. are expected to rise significantly. Japanese equities. Japanese equities are likely to rise as repatriated funds seek more attractive destinations. The BOJ's huge balance sheet, its substantial holdings of Japanese government bonds, and the potential blurring of the lines between fiscal and monetary policy raise concerns about fiscal instability. Japan's large net creditor position with significant instruments held abroad also has global ramifications. The timing of the Bank of Japan's policy exit is uncertain, but the longer it waits, the more likely the market will make the decision on its behalf, potentially leading to unexpected and disruptive financial market movements. Financial instability risks are on the rise, and the Bank of Japan's actions are expected to have a cascading effect through the global economy, impacting currency exchange rates, bond yields, and equity markets. So that's some positive news, right, folks? They continue to inflate their economy, and I mean, they've been doing it for decades, but I'm not sure why everyone's pointing at them when the inflation here in America has been pretty terrible too. All right, last up, an article from Mises Wire. It's titled, "A Fed-Induced Neutral Interest Rate is a Contradiction in Terms." Excuse me. The New York Federal Reserve recently reported that the estimate for the neutral rate for Q2 2023 has declined to 0.57% from 0.68% in Q1. This neutral rate, when added to the Fed's 2% inflation target, suggests that the federal funds rate around 2.5% would represent a neutral setting. Given that the Fed's current target rate is set between 5.25% and 5.5%, the interest rate policy appears to be very restrictive. The neutral rate, often seen as the rate that results in economic and price stability, is a concept rooted in the writings of economists like Newt Wicksell. According to Wicksell, the neutral rate is the rate at which the demand for physical loan capital matches the supply of savings without money affecting prices. This implies that when the market interest rate aligns with the neutral rate, the economy is in a state of equilibrium. However, the implementation of a neutral interest rate policy by central banks, including the Fed, is criticized as being unrealistic. In a free market without the central bank interventions, interest rates would naturally emerge at truly neutral levels without the need to determine an imaginary equilibrium. Efforts to determine the neutral rate and manipulate the market interest rate accordingly are seen as a source of economic instability, leading to boom-bust cycles like we're going through right now in the last couple decades. Thus, the idea of a neutral interest rate policy achieving economic and price stability is questioned, as it contradicts the principles of a free market, instead allowing interest rates to naturally form in the absence of central bank interventions is considered a more stable approach. In summary, the concept of the neutral interest rate as implemented by central banks is criticized for being unrealistic, contributing to economic stability. A hands-off approach in a free market is seen as a more reliable way to establish truly neutral interest rates. Yeah, get the Fed out of the problem or out of the way and let rates set themselves. I mean, banks will figure it out based upon, the amount of interest for borrowing and then also the people willing to save at that rate also. So it creates that happy medium. So anyways, all right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I shall talk to you next time. Adios.